Welcome back to the channel. As always, if you are copy trading, you are an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to speak today about a stock called TREX, ticker TREX. What these guys do essentially, they are a wood alternative deck supplier. So when you look at the typical American household, uh, a lot of things, especially in the outdoor section of the house, like decks and fences, are traditionally made from wood. And what these guys do, they provide a product which is a composite-based alternative to that. So think about resins and all the types of materials that are used to build these decks and fences to replace the traditional wood component. And so if we have a look here at what's been happening with the stock, we can see that obviously they did very well during the pandemic boom because there was a lot of disposable income available. And of course, many households were upgrading their uh, their infrastructure because everybody was working from home. So you can see how the stock, after initial pullback, went from about 54 all the way to 140. And now it's been for more than a year being having a bit of a delayed turnaround because of course as many other business they experience a number of issues as supply chains and the economy started having some issues. So one of the things that made me look at the stock is, first of all, when you look at the housing market, there are arguments on both sides as to why one could be bullish or bearish. As a matter of fact, this trade is going to be the long side of intra-sector spread trade that I'll be putting on the other side. And with these guys, what you see first of all is that they have a pretty long pattern here that goes from early last year, early 24, which now seems to be coming to an end. In other words, you could see this massive resistance here all the way, and now that has been broken through in the last few weeks. So that to me suggests that we could see the start of a new pattern. So this, I'm not saying it's going to happen like this, but we could see, for example, a channel that starts playing this way. But of course, all that is driven by fundamental reasons. Because when you look at the fundamentals, right, you see this as a stock that dominates the market. So they have about 17% market share, which leaves room for growth. After all, they're a 7 billion company, and they generate about 1.2 billion of revenue with 31% EBITDA margins. That is pretty significant because it's actually double than the industry average. Now, we've mentioned before that there are bullish reasons as there are bearish about the housing market. But when you look at this particular stock, this particular company, I would argue that the bullish reasons outweigh the bearish. And the reason for that is there are still a lot of strain in the consumer. Interest rates are still relatively high, even though it seems that the announcement on Friday is signaling that they're going to start coming down. But you could argue that the home purchasing activity is going to remain subdued over the medium term, right? However, that doesn't really affect the consumer that has already a property in place and want to make some improvements on it. I can see the consumer still or this segment of the consumer base still having enough purchasing power in order to conduct those works in their homes. So there's about 50 million decks in America, with about 27 million needing replacement. So again, that leaves plenty of headroom and total addressable market for these guys to gain market share, which they have uh, been growing consistently over the last few quarters. Now, they are converting 170 basis points of market share from wood every 18 months, and that translates to about 40 million in incremental revenue annually just from share gains. Now, while the renovations market decline from $1.26 to about $1 per square foot on home space, that's about 20%, they actually managed to grow their revenue at 5% and maintain 40% gross margins. So again, this is in a time where the whole sector is struggling, but management has actually taken the right steps in order to navigate that in the best way possible. How did they do that? Well, they came up with premium products that were growing double digit in terms of revenue. And now they represent 40% of sales versus 25 2 years ago. And that is driving revenue at $200 to $300 per square foot versus 150 for basic products. So that is pretty significant. And that leaves us now with the upcoming period that we're going to see, leading all the way till the start of 2026. There are a bunch of things that we could see happening between now and then, and this is one of the reasons why I am bullish on this stock. There is a sheer volume of catalysts that put the probabilities in our favor to make money when the stock goes up. First of all, they are opening an Arkansas facility uh, to achieve full production. At the moment, they are paying between 30 and 35 cents per pound for external recycled plastic. With a cost, this is going to translate to about 15 cents per pound. So they're going to save between 40 and 50% in terms of their materials. So that translates in about 15 to 20 million in annual cost of goods sold reduction and equates to about 150 to 200 basis points gross margin improvement. Now, we'll have to see how the production goes and how they scale in terms of capacity. They also have the full dealer conversions. So they have been adding dealers to their distribution network. At the moment, they have about 3,500, and they're adding 2 to 300 more per year. So each dealer adds about an average 250 to 500K in annual revenue. So we will see probably around September time how those new dealer incorporations are adding to their top line. But what we can see is that they're ahead of the last year's 250 conversions for now. And that is a trend that we expect should continue. Then in October, we should see as well the Home Depot 2026 shelf space. So at the moment, they have about 30% of Home Depot decking linear feet, and it is likely that they will increase between 10 and 15%. So when you look at the 2,300 stores that Home Depot has, they're expecting adding 3 additional feet, and that comes at about 20K per year in terms of the revenue per foot. That is about $140 million incremental opportunity. There is no evidence on this as of yet, but they did confirm that they have secured additional shelf space with them in Q2. Of course, we'll have to have a look at the wood market too, because the wood market is a 3.5 billion industry and is shrinking by 2 to 3% annually. At the same time, the composite market, which is the business that these guys are in, is 2.5 billion, but it's growing at 5 to 7%. And each 100 basis points of share, which again, these guys keep adding up on to consistently, equates to about 25 million per revenue, which is significant when you look at the financials of this company. So the current trajectory, we could expect them gaining about 170% basis points, which in about 18 months period would result in about 40 million annually. And last, in terms of catalyst, is the November period. So all those things should be adding up to margin expansion. Around that time, the Arkansas facility is expected to be fully ramped, adding between 100 and 200 basis points to the margins. And that equates to a new target of 44-45%, which is certainly an increase from the Q2 margin at 40% and higher than the Q3 guidance at 42.5. So that equates to about 35 million incremental gross profit. Another catalyst in November is the acceleration of railing attachment. So I mentioned before that they have fences and decks. Railing attachment is also one of those products, and that is all things expected to continue incrementing to add another 35 million EBITDA to the numbers. So when you look at all this together, there's a company here with revenues of 1.2 billion. They have an EBITDA of 360 million at 30% margin and free cash flow of 100 million. They have plenty of capex, as you would expect from a company of this nature. But after all these catalysts, we should see a very different picture for this business. We should see revenues between 1.35 to 1.4 billion. That's about a 15% increase. EBITDA going from 31 to potentially up to 34. And free cash flow significantly increasing due to the capex savings from 100 to 250. So that is a vastly different picture for the same company just a few months apart. So when you look at the valuation, you could see how the market was pricing back in 2024 the full turnaround of this story. And the stock was trading at about 45 times. This is well after the COVID boom, right? Where the stock, as you can see, got to as high as 60, but it was well in the range between 40 and 50. Now we can buy this business at 26 with plenty of tailwinds behind for it to reach maybe the 30th mark. Actually, we've been quite conservative here, right? So if we put that into numbers, right, the stock is trading at 64.48, and that's at a valuation of 26.8. So if we take that at multiple 30, we could say it's very likely to achieve a price of 72. But realistically, because the EPS will be growing as well, it could be very easily getting to the 80 mark. And that's between now and say January 2026. So with all these things, I see a very interesting business here with, like I said, plenty of tailwinds, but also multiple expansion, margin expansion, revenue growth. So the downside potentially could be here somewhere around 10 to 15 if perhaps something goes wrong. But the upside is much greater, certainly a lot greater than the numbers that I mentioned before. But I'm looking at this with a very high degree of conviction to play out over the next 1 to 3 months, and that's why I'm getting into it now. Hope you enjoyed the video. See you soon.